Hello, this is Andrew Thake from Minds and Money. Delighted to be joined with us today by Rick Rule, founder and CEO of Rule Investment Media. Great to go and see you again, Rick.
Andrew, thank you so much for the invitation. I look forward to seeing you again in person at one of your fine live conferences.
Yeah, we are certainly looking to get back to having some live events later on in 2022. But in the meantime, the joys and wonders of modern technology will just have to do. As we sort of talking to each other today, events are unfolding in Ukraine. In your view, what's been the geopolitical impact of events in Ukraine on the commodities market?
Well, the impact has been fairly obvious. I think the war in Ukraine points out a few things. It points out the importance of resources to the Russian economy. It really is all they do well. It also points out the fragility in the global supply chain. The fact that commodity prices, as an example, in the case of nickel, have gone absolutely ballistic with the Russian incursion. Obviously, in bigger markets like energy, Russia is a more important supplier to Europe. But it's important to note in commodities, Andrew, you'll know this, but maybe that many of the generalists won't. Prices are set on the margin. A 3% or 4% change in the balance between supply and demand can have a 20 or 25% impact on pricing. Mm-hmm. The fact that society has underinvested, in my estimation, in resource productive capacity for a very long time, in the face of fairly steady economic growth, set the stage for this circumstance occurring sooner or later. So I regard the Russian incursion into Ukraine as more of a catalyst or an instigator to a circumstance that was unfolding anyway.
Mm-hmm. You mentioned earlier there the fragility to supply chains. How do you think that we, as in sort of like the West, whether we're talking about US or like Europe, we need other parts of the world, need to rethink our supply chains going forward?
I think in a lot of ways. First of all, my hope is that saner heads prevail and each of the parties who are party to this conflict figure out a way to get each other out of the circumstance and the world returns to some form of normalcy. Remember that this discussion is about more than our portfolios, mm-hmm. Of course. I think that there will be greater attention paid to security of supply. This reminds me of the discussions that we had in the beginning of the decade of the 70s. Where, as an example, Japan was trying to muscle its way into supply chains that had hitherto been dominated by Europe and the United States. This circumstance, which is to say a period of time where society has underinvested in productive capacities around resources in the face of economic growth and a reorganization of the security of supply, forces itself on the world, is something that we've seen before, and we see how it plays out. It's fairly messy. Obviously, if you are Europe, particularly Northern Europe, you're going to rethink certain aspects of your energy policy. As an example, with the Germans relying on solar power where the sun doesn't shine, they're going to have to think through their objections to some other sources of power. And probably the Europeans are going to diversify or choose to diversify their sources of natural gas, particularly, of course, from North Africa. I think in Europe too, and around the world with regards to energy, it's going to change a discussion around uranium that has already been changing. Uranium has returned to favor, of course, because it's a source of baseload power that doesn't generate carbon loadings. But it's also, from a strategic point of view, the best form of power that exists. That's why the Japanese took it up with such earnestness after the Arab oil embargo in the 70s, because a fairly small amount of fuel in one warehouse in Japan could power Japan's electric needs for 5 years. Mm-hmm. I think people around the world are going to look at the disrupted supply chains with regards to energy and the energy transition, that will take place, and there will be a new prominence given uranium. I think too, Andrew, if I might continue just a little bit, what people don't understand is that over 40 years, the real price of natural resources relative to other economic classes has been declining. So it isn't so much that resources are becoming expensive now. It's just that they're becoming less cheap in a historical context. People need to understand that. It isn't so much that resource prices are going up so much as it is that fiat currencies are going down.
Mhm. Mhm. And in terms of just going back to uranium, is also part of your bullishness about it is also that it's also part of the decarbonisation play as well, in terms of if one sort of accepts like climate change and accepts that decarbonisation is the solution to like climate change, then how can commodities play a role? As you mentioned, like solar power isn't the solution as has been shown by your sort of example like Germany, but uranium and those modular nuclear reactors are.
I think that's a very important part of the discussion. Part of the changing political winds that favor uranium has to do with the fact that some elements of what had otherwise been considered to be the environmental community has come to understand that the world is going to consume more electrical power. And it's better in terms of baseload power if that's uranium power than coal power. One of the things we all need to consider, Andrew, but particularly in the resource business, is that this whole concept of sustainability, of ESG, necessarily involves a discussion of moving up the bottom half of mankind in terms of their access to resources, that is the poorest half of humanity. There are elements of the environmental community who came to realize that 1.2 billion people on Earth have no access to electricity at all. And another 2 billion people are experiencing energy poverty. One of our great accomplishments in humankind in the last 30 years has been the incredible upward progress of the poorest of the poor. In order for that to continue, those people want to live like you and I live a very, very energy intensive life. So we're going to need more of all forms of power. We're going to need more nuclear. We're going to need more solar. We're going to need, more wind. Some people will hate me for saying this, but the largest year on record for coal demand was 2021. To the extent that we are going to free the poorest of the poor from material poverty, there is going to have to be increasing supplies of lots and lots and lots of natural resources, including principally those around energy.
In terms of specifically again on the uranium, you've got a track record of sort of picking some winners in the uranium market. I think that Paladin is like a classic case of sort of study where you can have backed like Paladin, where everyone else was saying, Rick, don't sort of go there. But at the moment, there's like a lot of uranium companies coming out of the woodwork. I don't have figures to hand, but I'm guessing the amount of uranium juniors must have doubled over the last 12 months. How do you advise your investment community how to go and pick out those investment juniors to back and which ones not to back?
We are assuming an incentive price for new production at $70 US. The current incentive price is about $60, but inflation is taking place rapidly in the supply chain and also rapidly in terms of social rent. So our assumption is that the new incentive price in 2023, 2024 is $70. And so we're looking for net present value or prospective net present value at $70 a pound. Currently, we've identified 72 public companies that purport to be in the uranium business worldwide. We believe that 12 of those are buyable according to our own criterion. I would caution people that any correlation between now and the Paladin experience, unfortunately, is fanciful. I entered Paladin when uranium had been in a 20-year bear market rather than a 10-year bear market. And importantly, I entered Paladin when it had a market capitalization of $1.5 million Australian. Very often now, the penny dreadfuls, the earliest exploration companies in the uranium space, have $50 or $60 million market caps. It's difficult to get a 10,000% return when you're starting at a 50 million market cap rather than a 1.5 million market cap.
Turning away from uranium, one sort of big area of commodities we haven't sort of discussed so far is gold and precious metals. I think just before our interview, I think you've done a recent interview where I think, just quoting you, said it would be an extraordinary mistake to ignore precious metals. Why?
an extraordinary mistake, I believe.
Yes.
I think that all of the wind is in precious metal sales for reasons I'll describe in a minute.
Mm.
But in addition to the fact that I believe that the gold price and the silver price, at least nominally priced in US dollars, will go not merely higher, but much higher, I also believe that gold producing companies, on the metric that I value them by, which is net present value relative to enterprise value, are historically cheap. So let's look at gold first. My belief, despite the current rise due to geopolitical tensions, traditionally precious metals have gone up in price when savers are concerned about the maintenance of purchasing power in conventionally denominated assets, in particular bonds or savings products. Are those concerns justified? Well, let's look at them. The first concern, I think, would come from quantitative easing, government's word for counterfeiting. It is interesting to note that in excess of 30% of all the US dollars currently in circulation have come into circulation in the last 30 months. They didn't print those to accommodate the liquidity needs of an economy that grew by 30%. They grew them specifically for liquidity, which is to say they counterfeited. They added extra specious currency units. The easiest way to debase the purchasing power of something is to make a whole bunch more of it. And that's what they did with dollars. So quantitative easing makes savers nervous. But debt and deficits, credit quality, make them more nervous. The numbers in the United States at the federal level is that we owe each other at the federal level $30 trillion. But of course, it gets much worse. The net present value of current obligations, the off-balance sheet liabilities, entitlements, exceed, according to the government, $120 trillion. So we propose to pay off a $140 trillion liability with a budget that's $3 trillion a year in deficits. Pardon me, I missed 3 zeros there. Obviously, it's important. It's impossible to do. It's going to be rescheduled. That necessarily concerns savers. But the third is even worse: negative real interest rates. That's a guarantee from the government, the first that they're going to keep in my memory, that they make you poorer over time. The arithmetic around the US 10-year Treasury is simple and terrifying. They pay you 2% a year in a currency where the purchasing power is depreciating by 6.5% a year. The US government absolutely positively guarantees to reduce your purchasing power by 4.5% a year for 10 straight years. Jim Grant calls this return-free risk. If that isn't stark enough, Frederick Hayek called them certificates of guaranteed confiscation. The government is guaranteeing that your traditional forms of savings are going to cost you money. Now, that's important for 2 reasons. The first is that the biggest investors of the world, the pensions, the endowments, the sovereign wealth funds, often have had 40% of their portfolios in debt-related instruments. Over the last 40 years of falling interest rates, the capital stability offered by bonds and the stability of income was an important part of their arsenal. Now, 40% of their portfolio guarantees them that they won't be able to provide for their beneficiaries 10 years from now or 20 years from now. There has to be disintermediation out of these bonds unless somehow government stops quantitative easing, balances their budget, and stops negative real interest rates, something that I don't see happening. It's important, too, that if you assume that this disintermediation has to occur, that some of that money will flow into an asset class that has traditionally been relied on to shield people from inflation, which is to say gold. So the fifth element is that, at least in the US market, precious metals and precious metals related securities comprise about 1/2% of the total savings and investment assets of Americans. The 3-decade mean is 1.5%. So if negative real interest rates and all of those things merely compel savers to increase the market share of gold to its 3-decade mean, it triples demand for precious metals and precious metals related securities in the largest savings and investment market in the world. And that's precisely what I think is going to happen. The fact that all of these things are conspiring to come together in gold's favor, juxtaposed with the fact that the gold stocks relative to the gold price are the cheapest they've been in my life tells me that intelligent investors and speculators need to look at gold.
So if gold is obviously one good way to go and bulletproof your portfolio, specifically in gold, sort of digging down a little bit sort of deeper, do you see any sort of differences in value between exploration companies versus producers versus royalty companies at the moment? Would you advise sort of like a spread across everything, or are there certain areas which you're sort of a little bit more bullish about within gold?
I think it depends on how hard you want to work. Remember that exploration companies don't have gold. They're looking for gold.
Sure.
And if the price of something that you don't have any of goes up, it doesn't necessarily impact your fortunes, although it might improve the narrative around your fortunes.
Mm-hmm.
Right now, I would suggest to you that the values available in the very large companies, but particularly the values available in the sort of Northern Stars, the Endeavors of the world are really compelling. You can come down the size and quality trail a little bit, particularly if you're willing to take a little political risk. The B2 Golds, the West Africans of the world are generating such extraordinary free cash yields and have such stability of reserves and free cash flows that they are, by my reckoning, historically cheap. For many investors, when the flow of money goes into gold stocks, really goes into gold stocks in earnest, when the generalist money comes in, it's going to find its way into the biggest names first. It's going to find its way into the Barricks, into the Newmonts, into the Francos, into the Newcrests. So the first move could be expected to be the highest quality companies. The best values are found in the companies one tier down. If I'm right that precious metals commodities price increases and then the money flows into the seniors, then the money flows into the intermediates, when it comes into the juniors, when the money comes down market, and when the M&A cycle starts, you'll probably see a tremendous boom in the juniors. I don't see that necessarily occurring for a year to 18 months. I think the safer and bigger money in the intermediate term is going to be made in the larger, higher quality companies. As you know, Andrew, the juniors is my love, and I won't stop speculating in them.
Sure.
But I would suggest that that is a sector for people who want to work really, really, really hard and outperform the market. Just capturing the beta in the gold stocks will be enough, I think, but for all but the greediest of investors and speculators.
Sure. You just also mentioned the M&A cycle there as well. Obviously, there's been a little bit of a hiatus in M&A over the last couple of years with regards to COVID-19. Do you see an explosion of M&A in the gold space in 2022, now that we can go and travel again and go and obviously sort of like assess gold sort of projects before making the M&A deal?
A qualified yes. Okay. Capital will be more available to acquirers, both because of internally generated income, but also because of increased share price and a lower cost of capital. Unfortunately, the biggest impediment to M&A has always been that one management team loses. And the consequence of that is that if the management team of the smaller or weaker or lower priced company is able to forestall their execution at the hands of an acquirer through the capital markets, they'll do it. And so to the extent that the capital markets get too strong too quick, companies that otherwise should be consolidated for the benefit of their shareholders won't be for the benefit of their managers.
Mm-hmm. Yeah. One sort of commodity we haven't touched on so far is silver. One of the product challenges I always have as a sort of a retail investor is when I have a look at sort of silver stocks, there aren't too many silver stocks that have pure exposure to silver. It's often like gold and silver, or silver produced in conjunction with something else. If an investor is listening to this interview and wants to get into sort of silver, what's your advice for them? Is it, again, to look at like one tier down in terms of silver players, or would you advise a slightly different investment strategy?
The problem with silver is that there are so few silver equities, as you suggest. Mm-hmm. That's the upside and the downside. The upside is when the generalist market crowds into the silver space, as Doug Casey says, it's like trying to siphon Hoover Dam through a garden hose. The market capitalizations explode because there isn't enough market cap to control the money. The bad news is there isn't much to choose from. Mm-hmm. I'm excited that the market capitalizations of the extraordinarily high quality developers, the Mag Silvers and the Silvercrests as an example, have declined. The politically challenged producers are cheap, and given the politics, the current politics of Mexico and Peru, might be reasonably expected to stay cheap. The challenge comes when you get down into the tertiary companies, the companies that either don't make any money or don't produce, but might produce. There again, you need to do some real work. Had we had this discussion 6 months ago, I probably would have called your attention to Polymetal, the great Russian producer. Yeah. There's obviously reasons why you would need to rethink that strategy now. I will tell you this, Andrew, in my experience, the second half of precious metals bull markets become silver-centric. The first half, the narrative and the market move is driven by fear buyers, the gold buyers. But in the second half, it's taken over by the greed buyers. Silver, I guess, because of its inherent volatility and because of the low unit cost to purchase, is the poor man's gold. It's sort of the democratization of the hard money movement. And that means that when the narrative spreads through a broader part of the population, the explosive upside that one sees in silver is something that characterizes the back half of a precious metals bull market. I think now we're probably a year and away from coming into the second half of a precious metals bull market. And if past is prologue, that means that silver will probably outperform gold, and silver stocks will probably outperform every other asset class in the precious metals business.
Moving just outside the mining space for, I guess the final 5 minutes of this interview, what opportunities are you looking for outside of mining investment at the moment?
Well, despite the uptick you've seen in the oil and gas stocks, they're cheap. They're cheap because they're still hated. People get their energy information from Angela Merkel and Greta Thunberg and Joe Biden, and they aren't noted energy economists. Despite the low opinion the thinking classes have, the big thinkers have of oil and gas, most people, when they go to their garage and turn the key to the right, want the car to start. My view is that oil companies right now on a net present value basis are discounting $60 oil and US $2.50 gas in a world where the market prices are double that. The oil price could decline easily to $75 and the oil stocks would still be cheap. Despite popular opinion, world demand for oil ex-COVID is increasing, not decreasing. And that will continue for a long time. You don't need to think about the very rich German consumer or the very rich American consumer. You think about the increase in oil consumption that happened as a consequence of the urbanization of China, and think what happens as Nigeria urbanizes, as India urbanizes, as Indonesia urbanizes. The value chain goes from barefoot to sneakers, from sneakers to a bicycle, from a bicycle, importantly, to a 50cc motorcycle, and from a 50cc motorcycle to a Hilux. The person in Malawi does not go to a Tesla. And the increase in living standards in the bottom half of mankind is extremely energy intensive, and the most efficient energy fuel, particularly for transportation in the world, is oil and gas. And that, despite the World Economic Forum, is not going to change.
In preparing for this interview, I came across a really interesting quote that you'd made. And the quote was that one of your golden rules of investing is either to be a contrarian or a victim. What do you mean by that?
I've been very lucky at your live conferences, talking about stocks that were unloved and why they were unloved, and why you had to be a contrarian to buy them. I remember very well from your podium in London, advising people to buy a little-known stock that they hated, called Ivanhoe Mines, because it was in the copper business and nobody cared about copper, and it was in Congo because everybody was terrified of Congo. It turned out that people forgot that you need copper for electricity to work, so copper recovered. It turned out, too, that if you have a very high quality mine in a risky country, you can make a fair bit of money. The truth is that natural resource-based businesses are capital intensive and cyclical. And the way you really make money on a sector basis in the natural resource business is you look for a commodity that's selling for less than the cost of production. That is an industry in liquidation, where the commodity itself is necessary for the material standard of living for humankind. There's only one of two possible outcomes. A, the commodity becomes unavailable and all of humankind suffers, or the price goes up. In my life, it has always been door B. So when the copper price is at $1 and the incentive price for new copper is at $1.50, only one of two things can happen. Either the copper price goes up to the incentive price or the lights go out. Those are two choices. Looking back at the oil business, you and I talked 2 years ago when the oil price was at $20 a barrel. The International Energy Agency said that the incentive price for oil was $60 a barrel. So the industry is making the stuff for 60, selling it for 20, losing $40 a pound, trying to make it up on volume. Either the price goes up or your car won't start. You have to be a contrarian. You have to buy the best businesses when the businesses are in liquidation. And when you get to a period where you're enjoying 50 or 60% operating margins, unless you can see some reason like war, why those margins won't be maintained, you have to sell. When you're seeing on the cover of Bloomberg, oil derricks and gold bars and stuff like that, you need to think, you know what? I've been right for too long. When people yawn or laugh at you, or in the case of uranium, express hatred, you're in the right neighborhood.
And just one last question. I think I've asked this question sort of like before, and asked it slightly sort of differently. The book that I've been reading recently that I find that I would recommend as a tremendous read to anyone listening to this interview is Steven Pinker's Enlightenment Now, which I found a fantastic read. It actually does touch on some issues of decarbonisation and uranium that we've been talking about in our Fireside Chat. But is there one book you've read over the last year that you would recommend to people listening in?
Read over the last year that I think is particularly enlightening. I'll have to think about that, but I think if you constrain me to the last year, the answer is likely no. If you take me back, the most important book I've read in my lifetime isn't a business book. It's Human Action by von Mises, well known as an important sleep aid if you can't sleep. It explains the actions of individuals and groups in terms of acting in self-interest, and talks about how group interest is actually an amalgam of individual actions. It is the best book I've seen to describe recency bias. So I would say that the most important book I've ever read in terms of my own interaction with the world, but also in terms of my investment theory and practice, has been Human Action by von Mises. People who read it who don't like heavy reads will not like the recommendation.
Well, I mean, I'm sure it will be like a great read. Definitely would go and recommend it to some of our readers as good bedtime reading. I think we've kind of run out of time, Rick, but it's always a pleasure to go and have you on our online events. Definitely hope to see you in person again soon. That was Rick Rule, CEO and founder of Rule Investment Media.
Thank you, Andrew.